financial world.
The internet is obsessed with tax loopholes. You'll find someone claiming you can buy a luxury car and legally owe the IRS absolutely nothing. Reaching a $0 tax liability is entirely legal, and wealthy people do it every year. But it is not a quick hack or a simple cheat code you can apply on a Sunday afternoon. Getting there means trading the simplicity of a standard salary for a massive, documentation-heavy administrative workload. You have to actively choose to manage that complexity. The IRS essentially operates two different rulebooks. On the left, the W-2 earner. On the right, the wealth builder. Standard jobs are taxed first, and you keep what's left. But business owners deduct expenses first and are only taxed on the remainder. The tax code operates as a behavioral incentive system. The government wants to reward risk, business creation, and investment, so they wrote the rules to benefit people who do those things. Paying zero taxes means playing a different game. You're exchanging a simple financial life for a complex one, forcing you to decide how much administrative weight you're willing to carry. Let's look at scenario 1, the business owner. Notice the meters here. The capital required to start is low, but the administrative burden and audit risk are extremely high. The mechanical input is straightforward. You form an LLC or start operating as a 1099 contractor, and you maintain strictly separated bookkeeping for every single transaction. By doing this, you can categorize ordinary and necessary expenses, like a home office, a business vehicle, or specialized software, as pre-tax write-offs. These write-offs shrink your taxable bracket. If your business operates at a loss, you can use those losses to offset the taxes on your W-2 income. The catch is the paperwork. This strategy demands rigorous, flawless documentation. You have to prove every written-off expense was necessary for your enterprise. If you get careless and mix personal spending with business expenses, you expose yourself to severe legal consequences, heavy fines, and aggressive IRS audits. You cannot just buy luxury items and call it a business expense to save cash. The administrative nightmare is only worth it if you're genuinely attempting to build a profitable enterprise. Scenario 2 is built for players with cash. Real estate requires high capital to start, with a medium administrative burden and a medium audit risk. You deploy significant capital to buy rental properties and immediately take on the physical liabilities of being a landlord. What makes this lucrative is a complex mechanism known as the depreciation shield. Buildings break down. The IRS lets you write off the property structure, walls, pipes, carpets, creating a massive negative column called a paper loss. Through accelerated depreciation, you slide that loss forward. It entirely covers your positive rental cash flow, dropping taxable income to zero. Eventually, when the property goes up in value, you can sell it and use a 1031 exchange to reinvest profits into a bigger property, paying zero capital gains taxes on the sale. The trade-off for this massive tax shield is liquidity. Your capital is securely locked inside a physical building that you cannot access quickly. You also take on heavy physical costs, property management fees, constant plumbing or roof maintenance, and the ever-present financial drain of tenant vacancy. Real estate effectively swaps a liquid tax liability for illiquid property management headaches. It is a highly effective strategy, but strictly for those who have the upfront cash flow to withstand those physical costs. Scenario 3 targets the stock and crypto markets. Your capital requirement is variable, and both the administrative burden and audit risk are incredibly low. You invest your money into the markets and simply hold those assets for more than 1 year. That's the entire mechanical input. The benefit is massive. By holding long-term, you can qualify for a 0% federal tax rate on your investment profits when you eventually sell. But there is a severe limitation. To qualify, the IRS looks at your total combined annual income, including your W-2 job. If your day job pays a high salary, you disqualify. Pushing earnings past that ceiling jumps your tax rate to 15 or 20%. This bracket is a legitimate pathway to tax-free growth, but you only gain access if you are willing or required by circumstance to cap your primary earnings. While this passive strategy offers totally frictionless tax savings, its strict income ceiling renders it essentially useless for a high-income professional. Understanding the mechanics is only half the battle. You must match the strategy to your personal financial reality. Let's look at your primary constraint on this flowchart. If you have high time and low capital, your path is forming a 1099 or an LLC. The barrier to entry here is practically non-existent. It requires very little cash to start, making it the highest return tax move for a standard W-2 earner willing to do the paperwork. If you're a high-income earner making over $150,000 a year, that 0% capital gains bracket is entirely close to you. You must default to real estate. It's the only vehicle robust enough to shield a massive cash flow using heavy depreciation and paper losses. But before you act, remember the ultimate rule of wealth building. Never spend $1 just to save 25 cents on your taxes. The actual goal is to increase your net wealth, not blindly chase a zero tax status at the expense of your own money. To play this game, you have to treat your personal finances like a business. Hiring a professional CPA is not just a suggestion, it's the required price of admission to access the zero tax rulebook safely.